that starts discouraging that flywheel or disrupting that flywheel, either intentionally or unintentionally. And I think we're basically seeing a combo of both. I think that the move is kind of exhausted, and then we are seeing some policy shifts that add uncertainty and make maybe some of that capital want to repatriate or go home. And I think it's disruptive when it happens, but I think it's healthy ultimately because I think that it's gotten rather imbalanced. We've not really seen extremes yet this year. Back in March 2024, when we broke out to new all-time highs for the first time in a couple years, so Bitcoin hit something like 73,000. That metric got a little bit euphoric, but nothing like a multi-year top historically has been. And so we saw like a 7-month consolidation, but nothing really worse than that. And similarly, when Bitcoin hit 100,000 or up to 108,000 more recently, that metric similarly got a little bit overdone. But again, it wasn't one of those multi-year dislocations that we normally see. And so for me, I'm more on the lookout of ranges or probabilities of breaking out versus breaking down. And so my view is that there's still a higher probability of breaking up, and to say that I don't think we're set for a multi-year bear market until we probably reach higher prices.
Lyn Alden begins by sharing her approach to Bitcoin price predictions. Instead of setting strict price targets, she focuses on monitoring liquidity conditions and market euphoria levels. While she anticipated Bitcoin reaching $100,000 by 2025, it was notable that it briefly surpassed this milestone earlier than expected. Rather than zeroing in on exact price predictions, she assesses the likelihood of multi-year corrections based on market signals. Take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this. You can also explore our other videos on cryptocurrencies and the broader digital asset space. Drop your thoughts and insights in the comments below. Your interaction helps boost the YouTube algorithm and supports the channel's growth. Thanks for watching and enjoy the video.
I try to give conservative targets, and for example, I was pretty sure we would hit 100K, and we did. I thought maybe we would hit it in 2025. It was interesting that we touched it late last year. What I tend to monitor instead is levels of euphoria. So instead of saying it's going to go to this price by this year, there's a couple of things I look at. One is Bitcoin tends to correlate with liquidity conditions. It generally does better in conditions where liquidity is going up, which is in some ways another way of saying debasement's going up, which is different than just CPI. And then the other one is like when you look at some on-chain characteristics, one of the big ones I look at is market value compared to on-chain average cost basis. Because what I'm trying to do is look for the probability of a multi-year correction. Because that's something that obviously readers would want to know about.
Sure.
Want to be able to assess the probability of. And historically, whenever that metric goes up really fast, so the market value goes up like 5x or 10x, and a fairly small number of coins cause that big move. Like to put it in real estate terms, if there's like say 20 houses on a street, and like none of them have sold, bought or sold in years, and one of them finally changes hands and it's 50% higher than its last price, generally speaking, the value of that the whole street now is higher, even though only 5% of the houses, 1 out of 20, have basically now moved the price, the perceived price of all those houses. The same thing happens in a more liquid sense in Bitcoin, which is there's a bull market around the margins. It's tightly held. Some influx of capital comes in. Bitcoin goes up really quickly. But when you look at how many coins actually changed hands, it's usually a pretty small percentage in that initial bull run. And then you kind of like want to see that become more real. So for example, on that house street, you'd want to see another house sell at like a similar price, and maybe a third house before you say, okay, this is probably like something approaching the new price of the street. We can have more confidence in it. And the same thing with Bitcoin. When you see more and more coins trade hands at those higher price levels, it helps lower that ratio because basically the cost basis, the average cost basis is catching up to some extent with that wild explosion in market cap. And so what I generally point out is that we've not really seen extremes yet this year. Back in March 2024, when we broke out to new all-time highs for the first time in a couple years, so Bitcoin hit something like 73,000. That metric got a little bit euphoric, but nothing like a multi-year top historically has been. And so we saw like a 7-month consolidation, but nothing really worse than that. And similarly, when Bitcoin hit 100,000 or up to 108,000 more recently, that metric similarly got a little bit overdone. But again, it wasn't one of those multi-year dislocations that we normally see. And so for me, I'm more on the lookout of ranges or probabilities of breaking out versus breaking down. And so my view is that there's still a higher probability of breaking up, and to say that I don't think we're set for a multi-year bear market until we probably reach higher prices. So far it's in line with my base case, which was that they probably would have ring-fenced their existing holdings. So they have coins from seizures and forfeitures. And so whatever percentage of those coins that are, say, not returned to rightful owners, or legally rightful owners, that they would ring fence that, and that's what the executive order said to do. Basically, take those coins and put it into a separate reserve and don't sell them. I think the slight upside of the executive order to do it was that the Treasuries authorized to explore budget-neutral ways to accumulate Bitcoin a little bit more. I expect that to be kind of low numbers, but maybe I'll be surprised to the upside. And then they also, I think, did a good job of separating out Bitcoin from the rest of the cryptocurrency space, because they put those, again, from like forfeitures and reserves, forfeitures and seizures, they put them into a different bucket, and is treated differently, because the Bitcoin one, by executive order, they're not allowed to sell it. Whereas by the same executive order, the Treasury Secretary can use their judgment to figure out what they want to do with other coins, which can include selling them. And I think that's good, because generally speaking, you don't want a government picking favorites on assets that are kind of securities or have security-like aspects, like as they're entities with an issuer in many cases. And so rather than choosing different cryptocurrencies, many of which have a long track record of underperforming Bitcoin over multiple cycles, it's kind of just treating that as a separate, less important pool of capital, and instead kind of focusing on Bitcoin. But I think that the majority of the outcome is just going to be no longer them selling it, and we'll see what happens around the margins for further accumulation. I wouldn't bet my long-term bullish thesis on the idea that America is going to go out and buy like 500,000 coins. It would shock the price of the upside if they did. But my general bullish case is kind of assuming that it's roughly flat or flat to mildly up over the next several years.
She highlights that gold's strong performance aligns with its role as a hedge against the devaluation of fiat currencies. Despite a recent 40% year-over-year increase, gold's 5-year outlook remains stable, supported by global economic trends and strong demand from China and India, reinforcing its long-term value. Alden also addresses the role of stablecoins in facilitating global capital flows, noting that they help sustain foreign investment in U.S. Treasuries by offering digital dollar exposure outside traditional banking systems. This dynamic maintains the current structure of global capital markets, reinforcing the dominance of U.S. assets. However, over time, a shift away from heavy reliance on U.S. Treasuries toward neutral assets like gold and Bitcoin could transform financial markets.
So I think, it reflects a lot of the debasement that happened over the past 5+ years. It can take a while to trickle out. When everything was booming, people were more interested to put it in stocks than in gold. But as things eventually kind of slowed down, some of that capital, I think, spilled over more into gold. In addition, there's been a really strong central bank bid for gold over the past several years. Even though the rest of the world, on average, does hold more treasuries nominally than they did 5 or 10 years ago, it's a really slow-growing figure. And especially when you look at official holdings, like central bank holdings, it's basically flat to down on treasury holdings over like a pretty sizable timeline, like 10 years. That was really kickstarted by China when they said something, like 11, 12 years ago. They were like, it's no longer interested to rapidly accumulate treasuries. We're going to instead recycle this into Belt and Road Initiative stuff. So that was kind of a catalyst for this. But we have seen central banks continue to accumulate gold. And so there's been that shift around the margins that has been constructive for gold's price. In addition, there's always strong kind of consumer demand out of China and India. And so I think I think the gold price is in a good place. It's always a little concerning when you see something go up like 40% year over year. But I do think that the asset itself, when you look at, say, the 5-year performance, I think it makes a lot of sense. Well, I think stable coins already are proliferating pretty significantly. I do expect that to be up and to the right over the next 5 years or so, which through this administration and into whatever happens next. And I think the issue there is, if you look at those two charts you showed, the first one is the U.S. Is the rest of the world reinvesting in treasuries and capital assets, whereas the second one is basically having them invest in manufacturing facilities and put surplus into gold or Bitcoin and other kind of neutral assets. Whereas actually what the stable coins do is they keep the first chart in place. They keep a portion of the world reinvesting in treasuries to the extent that they're successful, and that's where there's a little bit of a conflict potentially.
Got it. So what do you how do you think this plays out then? What are you thinking?
My expectation is that this is probably going to be a very long process, much how the deindustrialization. I think the deindustrialization took decades to occur and reach a scale that became like politically among the biggest things, that to the point where the administration would start highly prioritizing it. And I think this is an initial set of first steps to say, okay, we're at least talking about the problem, doing steps to address the problem, and I think that there probably will be fits and starts along the way, and it'll take decades to gradually unwind that and kind of reindustrialize. Well, so I think it's basically a potentially initial unwind, a very tiny percentage unwind of a very one-sided trade, which is due to dynamics we discussed kind of at the beginning of this talk. A lot of global capital stuffed into U.S. stocks. Kind of like how a lot of global capital is stuffed into Canadian real estate and Australian real estate. For us,
I love how you keep bringing that up because it's so true. Like, you're 100% accurate. Yes.
There's certain parts of the world that we monetize, and for the U.S., the kind of the biggest, most liquid market is our stocks. And so the whole world monetizes our liquid assets pretty strongly, and basically that can become self-perpetuating, because that also strengthens the dollar, and then a stronger dollar hurts various emerging markets that have dollar-denominated debt. It kind of squeezes them, which makes them even less attractive to invest in. So even more global capital is like, you know what, I don't want to touch any of those areas. I just want to be overweight U.S. And that's a flywheel that's like self-perpetuating until either it reaches such extremes that it exhausts itself. Like every marginal, like portfolio manager is basically, net long or overdone U.S. stocks, and there's really not much more marginal flows that can happen. Or there's a policy shift that starts discouraging that flywheel or disrupting that flywheel, either intentionally or unintentionally. And I think we're basically seeing a combo of both. I think that the move is kind of exhausted, and then we are seeing some policy shifts that add uncertainty and make maybe some of that capital want to repatriate or go home. And I think it's disruptive when it happens, but I think it's healthy ultimately, because I think that it's gotten rather imbalanced.
One of Alden's key points is the long-term shift in global capital allocation. She explains how, historically, foreign investors have directed capital into U.S. stocks and treasuries, much like the way global capital once flowed into Canadian and Australian real estate markets. This pattern has led to a self-reinforcing cycle, where a stronger U.S. dollar makes emerging markets less appealing, further concentrating capital in the U.S. Alden believes this trend could be slowly reversing as global liquidity shifts and policy changes introduce uncertainty. Some capital may begin to move out of the U.S. and into alternative assets. This shift is expected to be gradual, unfolding over decades rather than years, as policymakers work to address the imbalances created by the excessive concentration of capital in U.S. financial markets. Please like and subscribe.